there, welcome back. Thank you for joining me again. When we talked about risk earlier, I mentioned that there are several ways of measuring risk. Well, one shortcoming of the standard deviation measure is that it treats the upside deviations from the mean equally as the downside deviations from the mean. Now, if you're wanting to maximize your portfolio value, there's good reason to think that you might be more concerned about the downside variation, which we might call as bad variation, right, relative to upside variation, which might be considered as good variation. Furthermore, you might even have a threshold in mind, right, a target return, that you would find values below as completely undesirable, right? So in this lecture, you're going to learn about the concept of semi-variance and measures of downside risk. These concepts are particularly useful if the return distribution is asymmetric. And this can happen with certain asset classes or portfolio strategies with, for example, option-like features. Or if the investor, for example, has a particular return target. All right. So what is semi-variance? Well, semi-variance is really very similar to what you know as variance, except that instead of squaring all deviations from the mean, semi-variance is computed by squaring only the negative deviations from the mean. And the square root of semi-variance is called semi-deviation. So how do we use semi-variance? Well, we can generalize it by introducing a return target, or which we can call the minimum acceptable return, right? And measure the deviations from below this target, right? This is what we call the target semi-variance. In other words, target semi-variance is the expected square deviations below that target, right? And what we call target semi-deviation is the square root of target semi-variance. Target semi-variance is usually what is referred to as downside risk. In fact, this notion of target semi-variance is really just a special case of a more general methodology for dealing with downside variation called the lower partial moments, or LPM methodology. So what the LPM methodology does is that it uses a downside return target, or a minimum acceptable return, and then defines any bad variation below that threshold as bad variation. So what are some typical targets? Well, typical targets might be the mean, or 0, or it could be even the risk-free rate. So the formula for computing the lower partial moments of any degree p, right, for a given target is given by, let me denote the LPM p for any degree p, right? So for variance, it's going to be 2, obviously, right? Is given by, and I'm going to define each term in a minute, di, d of I, right? And then the deviation from that target to the p power, right? So now let me sort of go through this expression with you and explain what it is. Right, so we have n observations, right? What is d of I? Well, it's an indicator function, really, right? That takes a value of 1, right? If the observation, the return observation, falls short of the target, right? So that's your threshold. So any falling shortfall from that is a bad variation. And it takes a value of 0, right, if the observation is greater than the target, because we don't count that, right? What is WI? Well, it's the weight applied to each return. Now, if, of course, you know, if we're equally weighted, right, then this would be simply 1 over n, right? So p is for any moment, but you can think of that if p is equal to 2, then you have the target semi-variance. Okay? All right, so now let's put this into use in an example. Right? So what I have here is a table of quarterly returns for the Russell Top 50 index, right, for the US. And it illustrates how we calculate the downside deviation for a sample of returns given a target of 0, right? So here is my tau here, right? That's the target, right? Here are the quarterly returns, right? So the first two columns, right, present the dates and the returns. The third column presents the indicator function, right? That takes a value of either 1 or 0, depending on whether the quarterly return is above or below the target, in this case, is simply 0, right? And then the fourth column is the deviation from the target, right? So using the formula that I just presented, right, in the spreadsheet, I computed the target semi-variance, right? So where the p is now obviously is equal to 2, right? And then I I first computed the target semi-variance, right? And then computed the target semi-deviation. Now you can work with the spreadsheet. You can find it on the website and play around with this spreadsheet and make sure that you get the same results. Okay. Upside risk. Well, just like downside risk, the upside risk is also known as upside semi-deviation, and it's the converse of downside semi-deviation, right? The only difference now is that we measure the deviation above the target level, right? Since upside deviation is presumably good, we can use this statistic to, for example, identify those distributions that are more desirable than others. All right, okay, so in this lecture, we reviewed volatility of returns as a measure of risk. You also learned how to measure downside risk using lower partial moment measures. In particular, the downside risk measure of semi-variance is a special case of the LPM methodology with p power equal to 2 and the target equal to the mean. Downside deviation statistics are especially useful in dealing with distributions that are not symmetric and in comparing distributions that have different means.